So today we're going to go over how to use the RV park acquisition model to analyze potential RV park acquisitions. I just chose this random RV park listing on LoopNet. It's Trojan Station RV Park. I have never seen this property before. I don't know anything about it. So we're going to be making some pretty big assumptions to plug into the model and see whether or not this is an investable RV park acquisition. So let's dive into it. So right away, we can see I've already put in some inputs here. It's the name, the address, and expecting to close on January 1st, 2026. And you can see right away that it's got a 6.58% cap rate in Troy, Alabama, which is a bit of a red flag. I mean, these cap rates are a sloppy way of evaluating a property like this, but that's a pretty aggressive cap rate in a rural market in Alabama. So we'll take that with a grain of salt, but that doesn't inherently mean it's a bad investment. In fact, let me check what that is per site. There's 76 sites, so $21,000 per RV site, which even in a rural market, like that's not bad right out of the gate. That's not a terrible offering. So this could still work with the right TLC. So let's see what the numbers say about it. But still right away, like I said, 6.58%, they're probably expecting a pretty significant counter offer. So I'm just going to go ahead and bump it to, let's do 8%. So 1.3 million and some change. That sounds like a good price to me. I'm going to up the closing cost a bit. Maybe this one has a little more attorney fees, or I used an agent or something, but let's just call it 3%. And for the seasonality, I'm going to leave it at 12 months. We're going to stay open all year to capture all these extended stays, which they're saying 76 RV sites at an average rate of $525 per site. I actually didn't see anything in the listing about whether or not electric is included in that. Probably not. But just eyeballing it, I got 35% occupancies are going in. So $14K a month gross on the RV sites, which is not fantastic. And I think makes that $105,000 NOI a little suspect. We'll dive into the other income later to round that out. But anyway, for the acquisition financing, let's assume 65% LTV and 7% fixed interest rate and a 60-month term. Really all I'm doing here is matching the term length to the hold period length, which is also 60 months. But and I'm not really saying that these are standard or this is like the gold standard of financing. I mean, you could have many different rates, many different structures, but we're just going to make these assumptions here and match the hold period, and we'll move on. So 240 months, 20-year amortization, and let's assume that it's a really nice bank. We're going to get 24 months of interest only, kind of help our returns a little bit and operations in the first years as we ramp up. And I've already put a formula in here to add 50 basis points to the acquisition cap rate. Something this rural, there's just some risk involved in this, even just the 5-year horizon. I'm just going to assume that the cap rate's a little higher than our going in. And just for the sake of being consistent, I'll match the closing cost to 3%. And then next we'll hop over here to the operating expenses. And I was pretty aggressive with this because, just look at the condition of the place. I mean, the sites are strange shapes, and the layout is kind of awkward. There wasn't really a thoughtful design here. And I'm just assuming it's a older park, probably got some issues. There's all kinds of surprises that could be hidden in something like this. So I'm going to assume a 12% repair and maintenance ongoing monthly amount. And what else? Let's see. I think 60% OPEX ratio is reasonable, if not maybe a little bit low. In fact, I think this repairs and maintenance, I think it needs to be higher. I think it needs to be 15%. And maybe we find some savings somewhere else to knock that OPEX ratio down. Maybe it's electricity, but electricity is already pretty low. You know what? I'm going to leave that at 10%. So, maybe that's just the OPEX ratio. Just looking at it, I'm not sure that we could really do a whole lot better operationally. Maybe someone could knock it down further, but I think to be prudent here, let's just assume 63%. And I've even got a 3% property management fee here, which is really a placeholder if you're going to self-manage the property. And I assume the other wages, maybe there's another part-time staffer or two, and that's what's captured in the salaries and wages. But then the property management side is just going to be a self-managed deal. So you put 3% there instead of 8, 10, 12% to hire a full-time manager. And then for the other income, for the utility reimbursements, that can include whatever you want here. Maybe it's just electricity. Maybe it's all of these: electricity, water, sewer, maybe even internet. But I'm just going to make it what I think would be a reasonable recovery amount for the amount of expense that we have. Laundry, it did say in the listing that there's a laundry facility, so I'll assume $500 a month there. And then just, I don't know, $250 of other income. I didn't see any other revenue streams there, but we'll assume there's something. And then we'll assume a 2% economic vacancy for credit loss and discounts and promotions. Really, 1 to 3% is what you need for credit loss. I think you should always put at least 1% in that line item. And 3%, maybe a park like this, 3% would be reasonable, but I'll just split the difference here. Anything over 3%, you're really not counting on your tenants or guests to really pay up. So anyway, so this is your acquisition scenario, and this is your year one operations is really what we're looking at in the center sections here. Acquisition, this is, you're going in, and as you can see, it's on the right side here, the investment performance is really bad because we're going in a little too high on our price, and operations don't look that great. But let's assume we do some renovations here and get this thing really turned around in the first year. So we'll assume $100,000 of renovations. Maybe that's infrastructure, pedestals, septic tank. Maybe it's adding an amenity or two, just some kind of repairs to draw more people in and command a higher rate. So we'll change it to $550 a month. And instead of 35,000 or 35% occupancy, we'll say that in year one we get it up to 50%. And you can see based on the investment performance, it's still not doing great. So even increasing the occupancy 15% and the rate slightly in year one, and I've actually got the growth rates you can see here higher for the income side. I'm assuming that the trend continues where we're adding more occupancy, more revenue, so it's outpacing general expenses, and it's still just not a very compelling story here. So let's spend the big dollars and really renovate the place. Let's go to $200,000 of CapEx and really increase this occupancy a lot more. And then we'll make the utility reimbursement match what the actual expenses are now that income's coming in at a higher pace. And now it starts to look a little more interesting. Low to mid 20s levered IRR. You got a solid debt service coverage ratio if the banks will lend on that forward projection if they buy your business plan and who you are as a borrower, then maybe they'll do that deal. And then a 2.25 equity multiple, that's pretty good. And you can see the NOI here is dramatically improved from where we started from. and that's at the time of sale. So in 5 years, we've got it up to that. And the closing costs, like I said, matched 3% from earlier. That's your note that you got to pay at closing, whatever's left on the mortgage. And then your net proceeds are 1.4 million and some change. That's on a going in equity of 460,000, and then of course your $200,000 of renovations. So on 660,000 of equity, you're getting out 1.4 million over the course of those 5 years. So your plan did pretty good. Your renovations, your marketing, your management, everything looks like, even with the 63% OPEX ratio, you did pretty well. And I still think that 9% is probably a more realistic acquisition cap rate, and then this really looks a lot better. I just think that going in cap rate should be much higher than it was. I think I said lower earlier, but yeah. So there's the analysis of Trojan Station RV Park, and you can see how this model is pretty simple to use. You could do a whole bunch of these really, really fast. So if you're interested, go ahead and like and subscribe. That helps. But if you want to actually get the model, you can find the link and a promo code in the description. And good luck on your next deal.